Act, still private insurance remained unaffordable or simply unavailable to many, including the poor, the unemployed, and the elderly. Before 1965, only half of seniors had health care coverages and they paid three times as much as younger adults while having lower incomes. Consequently, interest persisted in creating public health insurance for those who left out of private marketplaces. The 1968 Culmer Act provided matching funds to the states, which is assisting patients with their medical bills, and how in the benefit to attract the best employees, private sector, white collar employee nationwide expanded the US healthcare system. Public sector employers followed suit in an effort to compete. Between 1940 and 1960, the total number of people enrolled in health insurance plans grew sevenfold from 2066 to 142,334,000, and by 1958 75% of Americans had some form of health coverage. By 1976, 85.9% of the employed population 17 to 64 year of age has hospital insurance, while 84.2% had medical insurances. The total aggregate inpatient hospital cost in the US. The US has a joint federal and state system for regulating insurance, with the federal government ceding primary responsibility to the state under the McCarran-Ferguson Act. State regulates the content of health insurance policies and often require coverages of a specific type of medical services or healthcare providers. State mandates generally do not apply to the health plan offered by large employers because of the preemption clause of the Employee Retirement Income Security Act. As of 2018, there were 395 953 health insurance companies in the US. Although the top 10 account for about 53% of revenue and the top 100 accounts for 95% of revenue. Employer sponsored. Employer sponsored health insurance is partially paid for by businesses on behalf of their employees as part of an most stated, and some states adopt them with little or no change. However, with the Patient Protection and Affordable Care Act, effective since 2014, federal law have created some uniformity in partnership with the existing state-based system. Insurers are prohibited from discriminating against or charging higher rates for individuals based on pre-existing medical condition and must offer a standard set of coverage. California. In 2007, 87 of Californians had some form of health insurances. Services in California range from private offering HMOs, PPOs to public programs. Medical, Medicare, and Healthy Families SCHIP. Insurers can pay providers a capitation only in the case of HMOs. California developed a solution to assist people across the state and is one of the few states to have an office devoted to giving people tips and resources to get the best care possible. California Office of the Patient Advocate was established by July 2000 to publish a yearly health care. Republicans voted in favor of its either time. State and federal regulations. Historically, health insurance has been regulated by the state consistent with the McClellan-Fergus Act detailed for what health insurance could be sold were up to the states, with a variety of laws and regulations. Model Act and regulation promulgated by the National Associations of Insurance Commissioners NAIC provide some degree of uniformity state to state. These models do not have the force of law and have no effect unless they are adopted by the state. They are, however, used as guided by administration's top priority, the Patient Protection and Affordable Care Act, which was similar to Nixon and Clinton plans mandating coverage, penalizing employers who failed to provide it.